Hi there, welcome to the Dynamic Investor Program video report for December. So this is to be viewed in conjunction with the written report. Just a quick reminder about general advice. You've all seen that before, but just need to keep reminding you of that. And let's have a look at an overview of the market, because in the last week we've seen some events that really allow us to modify our approach a little bit to the market, and that was the coordinated action of central banks, which has removed the short-term liquidity crisis that was threatening to take us back to somewhere like what we had with the collapse of Lehman Brothers. There was plenty of discussion and rumour during the week that there was a large European bank was about to go under, and I guess authorities have learnt their lesson from 2008 when they decided to let Lehman Brothers fail, and that nearly completely sank the global financial system. So they've all stepped in pretty smartly, and that removes now that immediate short-term risk. So we're going to see a rally in the market for a little while, and we had a very strong move last week. So just a bit of an overview. We are at the start of a rally into Christmas. I think especially so for precious metal stocks. They are so far behind the eight ball. It's not funny. They really got some serious catch up to do. The fundamental case is very strong. They are cheap. The technical case is very strong. So it's really just a matter of getting entry into them. In Europe, the basic problem hasn't been resolved, but they've gained some time because that short-term threat of a significant move down has been removed. Gold's starting to respond. We'll have a look at the gold chart. May have a little bit more downside yet, and may take a few more weeks before it breaks out completely, but I think it's pretty close. Looking at China, they eased lending restrictions as well at the same time as the central banks moved, and that's providing a boost to commodity prices. The Australian dollar's gone up. Our resource stocks are going to start to kick in as well. Now in America, the QE3 is pretty close, or it's already underway in disguise, and I guess in a way the US has really participated in a sort of a money printing exercise for Europe already. Gold, the fundamental picture just gets stronger and stronger, and technically, as I'll show, we're getting closer to that final breakout. And silver eventually will outperform gold. It could be a month, 3 months, 6 months away before that happens, but it is going to happen. We're going to see a massive outperformance in silver. So our overall strategy is moving up progressively as entry opportunities present themselves to 60% maximum exposure. We're currently sitting at 42. And as we make our way to 60% exposure, I'd be looking at having about 40% of that in precious metals. Getting down to specific stock selection, the research I'm doing on gold producers is ongoing. It doesn't stop, and I'm very clear and confident about which stocks I want to buy. The only difficulty has been that the entry prices on the best trending stocks have not been all that easy to get, but we did manage to get good entry into a couple of them: Troy, Silver Lake Resources, etc. And obviously going to continue to add to our precious metals exposure via the ETFs, and also some diversified resource majors as well. And looking for on other stocks, non-gold stocks and even non-resource stocks, as I've been indicating over the last couple of months, looking for stocks with high return on equity, high growth in earnings, stocks that are paying dividends, and if we can buy them at panic prices, I don't think we're not going to get that opportunity prior to Christmas, I don't think, but perhaps early in the new year we may see a bit more of that return, so that will be the opportunity we'll be looking for then. Now, before I move on to the specific stocks, I'm just going to go to the charts, and we'll have a look at a couple of stock charts. This is the S&P overall. I've outlined this in in the general videos for trading members, but it's important to do it here again. This is what I see happening. One of two scenarios, perhaps a move up towards, we form this big wedge pattern. I think we get a move up into Christmas as long as it stays below 1305. Then I would expect a bit of a correction back, and in the bullish scenario, as long as it holds above 1220, we could then get a new bull market, which could last for 6 months or perhaps longer. It doesn't change the view that at the bigger picture beyond that, we're still in a bear market. We could still accommodate that. I think as long as we stay below about 1370, then I think we're still in an overall bear market. So that's scenario one. Scenario two is that we rally a bit more weakly, maybe to around 1290, bit of a weaker rally, and then the market goes back into decline. I don't know which one of those is going to apply, and it will depend very much on political decisions. So we've just really got to treat it day by day. Now let's have a look at the gold chart in US dollars. So this is a weekly chart, and you can see we've got a big triangle formed here, which is to be expected that after the massive move up we had, which ended at the end of August. We're now September, October, November, we're now 3 and a bit months in to that consolidation, which is about right. Somewhere between 3 and 4 months would be normal. We're close to this 30-week moving average, which has supported the price for a long time now. So a bit of a move down to just under 1700, I think, would be an excellent entry point for gold ETFs as well.